All right, so let us start. So hello everybody and welcome to Vantage. So today we are on part 3 of our trading fundamentals, the 12 critical techniques for new traders. For those of you who don't know me, my name is Tamar Mer and I'm part of the trading team at Trade with Precision. Now, before we head on to the presentation, we need to go through some risk warning and disclaimers. So please have a read through them, make sure that you agree with them before continuing on to the presentation. I'm going to give you a couple of seconds to read this disclaimer slide. All right, so what is on the agenda for tonight? So tonight we are on part 3. Tonight we're going to talk about momentum indicators. So we're going to talk about the MACD, the RSI, and the stochastic. We're going to talk about ways that we can incorporate them in our trading strategies. And then we're also going to talk about some pivot points and Fibonacci. So we're going to basically build on top of what we've discussed last week. So just to refresh your memory, last week we spoke about trend, support and resistance, and a candlesticks chart. So what we're doing is we're looking at technical ingredients, technical elements that really, if they come together at the exact same spot, kind of like a beautiful ducks in a row, then we could say that we have a high probability opportunity. So what we're looking at really when we're looking at our trading strategy, we're looking at reasons that the market from this point onward, this precise point onward, is going to go, let's say, higher rather than sideways or lower. So we're looking for probabilities. And with every element that we add into our arsenal, we're looking to increase those probabilities. So if you think about it, when we're talking about a trading strategy, when we're talking about, before we even talk about a strategy, when we're talking about where the market could move, what the market can do, the market can either go up, down, or sideways. There's no other ways that the market can do. There's no flip side or anything else. So just by looking at this, if there's no other piece of information, each direction have about 33% of being the correct direction. Now, if you think about it, trading is about the only profession that by knowing absolutely nothing, you have the ability to be 33% of the time right. But we don't want to do that, because if you think about the risk that inherits with the idea of trading, because every time we enter into an opportunity, we're opening ourselves to risk, 33%. It's not a good idea. If you think about jumping off a cliff and you have 33% of surviving, we're probably not going to jump off that cliff. So we want to increase these probabilities, right? We want to increase the odds that the market is going to go in the direction that we have perceived, rather than reverse and stops us out. And even a market that goes sideways, what we'll see when we talk about momentum indicators is that we're actually going to start losing momentum. So we're going to start losing that conviction of where the market might go. Now, in this day and age that we have quite high interest rates on many other pairs, sometimes it will cost us money. Sometimes we might even earn a little bit of money, but it could be if we decided for some reason to short something like dollar yen, then we're going to end up paying quite a lot for overnight charges. So we really don't want to stay in a trade if it doesn't really meet our criteria and we're losing that initial momentum that we perceive for the market to have. And that is sort of the information that we can get out of those momentum indicators. So what we're going to discuss today is how can we identify a momentum in a move. So how do we know if the momentum have a higher likelihood of continuing? Meaning, let's say I'm looking at an uptrend and I'm seeing a pullback. How do I know that this pullback have a higher likelihood of continuing rather than have a little bit of a peak higher and then reverse and completely go the other way? So is there some sort of an information something of a leading indicators that can tell me, hey, watch out, a pullback is about. So you're actually running, you're trying to buy the market, but you're running into an increasing amount of sellers. Wouldn't we want to know about that if we decide to buy? So today we're going to cover the idea of leading indicators. So there's a couple of elements that we can utilize, and part of them will be the pivot point and the Fibonacci retracement, and at some point even extension to a degree. So let's start with the momentum indicators. Now, what I'm going to also do, I'm going to talk about a traditional way of using those momentum indicators, and I'm going to point to a little bit of holes in that tradition. Now, it doesn't mean that it's wrong. It doesn't mean that it can't work, but it would be wiser of us to know what are the issue with each of those traditional ways or with each of those usages, because knowledge is, or I rather say the application of knowledge is pretty much our power. So this is what we're looking to do. We're looking to take our knowledge, put it into reading the market, a technical reading of the market, and look for a potential move. So I'm going to talk about those elements, explain them, and then explain where they can be actually something that we need to pay attention to. So what can go wrong with that idea? So let's start here with a couple of elements. So MACD, as an example, there's, or if we don't know what it is, it's a moving average convergence divergence. We don't really need to calculate it. When we add it into our platform, then we already have the box setting, and this is what we're using. Now, part of the traditional way of using the MACD is to look for a crossover, right? So you can see here, and let me just take the pen so I can draw on this chart. And by the way, guys, and I'm happy to see some familiar names here. I want to say faces, but it really is names that I can see. So welcome back as well. So when we're looking at the idea of the crossover, what we're basically trying to say is that if the market was going lower in this case, and now we crossed over, then is there a chance for the market to start going higher? Now, I want to point out the place that the market crossed over, and this is this area. And what we can see is that really from this area, from these candles over here, the market has started to slow down its pullback. So we get small candles. Remember, we spoke a bit about candlesticks last week, and then we had a push higher, then a pull back, and now we're starting to pick up momentum again. So it doesn't necessarily mean that this crossover, it could have gone a little bit more to the sideways, and what we ended up with is another crossover here. So we need to be careful from a situation like that, and we can see that happening here. So actually we have an example of this. So as this market is pulling back, and you can see it's bouncing off a support level. So we did discuss support resistance level last week, and we can see we've got a touch and another touch and another touch. And what the market is doing, after breaking through this level, we're pulling back to test it from above. You can see we've got another touch here, and we can see those touches here as well. So clearly a level of support and resistance that been resistance, and now it's offering us support. So let's see what happened here. So when the market, the MACD crossed over and basically said, hey, we are going into the bearish sides of things, we crossed over here, right? We would expect the market to go lower because that's what the signal is telling us. But look what happened. We basically went sideways and crossed over again. So if we would have looked at this as an all and be all signal, if we would have looked at this and say, my signal to enter my trading strategy is basically same. If I have a crossover, I have a signal, and I ignore everything else, then what would happen here? This would be a losing trade, because that was not a sell signal by any means. We have a support level here that the market has been kept on bouncing off. So if we were thinking of it as being a momentum breakout to the downside, we need to have a bit more elements to support that direction, which we don't. So this is an example of where the MACD crossover didn't necessarily work, right? Because what happened, it crossed over again and pushed to a massive higher high. So if I was sitting here trying to sell, I'll be triggered just before this massive buy is coming. So I really am selling into a massive amount of buyers. So you can see the problem with this idea of using this as the all and be all indication. The other thing that we can see is that let's have a look at what's going on here. So the market is making a higher high, and it's a strong push to a higher high. So we could imagine what we spoke about last week. If we had the moving averages here, we can imagine the moving averages getting overextended. Why? Because this is quite a big move and quite quickly. When the market moves fast and quickly and with big candles, we create overextension. Remember what we mentioned last week when we said, what happens when we've got overextension? So for those of you who haven't been on the webinar last week, overextension is when we have quite a distance between price action and the moving averages. So if we have that distance, what are we expecting? We're expecting a bit of a pullback, either a bit of a pullback or maybe sideways into the averages, but we don't expect the market to keep on going on and on and on and on without some sort of a pullback, right? So we will take a look at what's happening here. We start to see this sideways action. We have a touch here and another touch here and a pop and a coming back into this area. That is quite a bearish sign, especially at overextension. Now, if we take a look at what's happening here, at this point in time, the MACD is still pointing to a buy, right? We haven't yet got a sell signal. The only time where we actually got the sell signal was happening here. Now, look what happened. At this point in time, this is the pullback. Back here, we're probably back into the averages, right? So the pullback has already happened. There is no guarantee that this thing will continue lower. We could find ourselves in an exact same situation as this. So what happened here is that the MACD signal came in too late. So yes, in this sort of situation, it might have worked for us. The break was happening somewhere around here. The MACD told us to us a little bit before the break. It could have worked. What we happen here is it is too late. When the MACD told us of the push lower, so the sell signal, it already happened after the market dropped quite a lot. It's almost 200 points here. So from this, you can see that the MACD signal just on its own might be a little bit off. It can be too late or wrong altogether. So one thing that we can utilize the MACD is indeed for this crossover, but we need to be aware of its limitations. So I would always combine it with price action itself. So it's not just when the MACD crossed over, it's rather what did the price action did when the MACD crossed over. All right. Any questions about this idea? Okay, so let us continue. So the next thing that we're going to talk about, the next indicator is the RSI, or the relative strength index. Now, the relative strength index, what it looks to measure, it's an oscillator, right? So it within a band, with the parameter of the extremity, absolute extremity, so it would be between a 0 and 100. So it cannot break above 100 or go below the 0. So it's an oscillator. And what it does, it basically, we're looking at areas and we're saying this: if the market moved a lot and it keeps on buying and buying and buying and buying, then at some point we will go into an area that we will describe as an overbought. Basically, an overheating movement in the market. It already moved a lot and therefore we're expecting it to pull back. But there's an issue with that as well. And before we get into that issue, I want to mention that we also have the oversold area. When we've got the market going sell off and sell and another sell and another sells, that will bring the market closer to, and potentially into the oversold area. Now, the extremity that are conventional in the market are the 30 and the 70. Okay, so below the 30, it's the oversold. Above the 70 is the overbought. So let's take a look. So if you take a look, let's say at this area here, let's look at an area when it actually looked nice and worked. So we're sitting here at this area. So you can see the RSI is getting up to the overbought area. We had a strong push, market moved higher quite fast, and we're sitting right around here. So we're sitting right around here. And what we're finding is that we've got here the RSI in the overbought. We pretty much had quite a strong push over here. We're probably a little bit overextended, and the signal of oversold actually worked. Happy days, isn't it? Not quite. Have a look at this area, for example. Here's the market touching the overbought. Here's the market touching the overbought. Did we really have a strong pullback? If we were in a trade here and we tried to sell, we're actually going sideways over here, tiny little dip, and off we go. This one is even worse. We hardly even had a pullback over here. We'll be sitting pretty much sideways, and then we have a very strong pop. So at this point, we will be stopped out. So you can see that even though the market reached an overbought area, right, we actually don't have a good signal here. So there's an issue with that signal. What about the oversold area? So in this case, it worked quite nicely, but hold on. You can see this line over here was also the oversold. It touched that oversold area, but we kept on lower. In this case, it worked. We went into the oversold and we got a strong buy coming out of that area. Let's have a look at this thing. So if we decided that this, you can see this one is pretty deep here. So if we decided that this is a great oversold area and we decided to buy, we're actually buying into a fresh line of sellers, which are able to push the price even lower. So the overbought and oversold have their own issues. It doesn't mean that when the market gets into those areas, into the overbought or into the oversold, we're actually having an excellent signal on its own. So once again, on its own, not a fantastic 100% or maybe even 80% right signals. Let's even talk about that. But it can increase the probabilities if I align it with other elements. So once again, it's pretty similar to the MACD. On its own, it's not a very strong signal, and it's definitely not a strong one. Just on that's it. That's the reason to enter, right, or the reason to exit. It is not enough. So what we want to do is add a little bit more into that story. So another thing about the RSI that I would mention is that it's a lot more sensitive. So it's calculated on a shorter period, usually on 14. It's a lot more sensitive. And just by the look of the chart itself or the line itself, you can see it's a lot more fitty. Right? There's a lot more sensitivity here than if you look at something like what we had before. Let's just bring it back. Right here, you can see the MACD is a lot smoother. Okay, so it's a good thing to understand the difference between those momentum indicators. So the next one, and this is another oscillator, is the stochastic. Now, with the stochastic, we're looking at it pretty similar to how we looked at the RSI, and that is for an overbought and oversold areas. In the stochastic case, we're looking at 20 and 80. So below 20, it's the oversold area, and above 80 is the overbought area. So let's have a look at this example. So we can see here, for example, in this example, it worked. We got into the overbought area and we had that pullback. In this case, not necessarily what happened here. We just went sideways. At this point, we dropped below, the overbought area and started to go sideways. And only here, we had a little bit of a push. We went into the overbought area, but most of the time just went sideways until this point where we pushed higher. Now you can see here all of this was in the overbought area, which we started to go lower in here, but came back up, lower, came back up. So really, we haven't been going much lower. So this thing hasn't really worked. But let's take a look at this, overbought, but we're not going anywhere yet again. So once again, you can see it's not complete. This element is not giving us a complete idea or a high probability signal to enter on, to exit on its own. But what else can we see about this one? So there's a couple of interesting elements that we can take a look on or start to assess. So we have those levels of support and resistance. So let's have a look here. So I'm going to look at this level right here. Let's take an example. So you can see there's a touch and another touch, and there's another touch here and another touch here. So on here, it's been support, it broken, and now it's authorized resistance, right? So we've got these touches right here. And I've got here what we can really say equal highs, right? But what also I can look at is I can see what are the momentum indicators are doing, or in this case, the stochastic, because that's the only thing that we've got here. So what we've got here, if I compare the high, so if I take a vertical line right around here, I can see this high, and then I'm going to take a vertical line from this high. So what is very striking is that when the market made equal highs, the momentum indicators, in this case the stochastic, made a higher high. So if you think about what is it telling me, right? It tells me that there's a build-up momentum from the buyers. Even though price action haven't been able to print a higher high, the momentum indicators are telling me basically that if and when the market is going to go and break those highs, there's a higher likelihood that the buy will continue. So if you think about it, it wasn't so clear if we're sitting on the overbought and oversold if we have a good signal. But once I go and I combine it with price action, and as you can see, it doesn't really matter that I'm sitting here in the overbought area. What I've got here is a very, very nice convergence to the upside, or basically this having equal highs and the momentum indicators are making very strong higher high. It's not even a is it not, it's pretty obvious. Then if I'm looking for a break higher, this gives me extra confidence. It's kind of like a backwind pushing the momentum of the market a little bit further in that direction. So that is comparing high in a push higher. What I also got here, and it's not a precise level, but we can actually take a look at this. So when I'm looking at these lows right here, so if you think about it, I've got here a high, a low, lower high, and a lower low. So if you remember the previous session, we were actually now confirming a downtrend, right? So now we have another pullback in here, and I want to know, if we go ahead and break these touches over here, am I actually going to go lower? Is this thing have a higher likelihood of continuing lower, or am I running into a bunch of mega buyers that sit just underneath this and going to stop me out? So I'm going to look again at the momentum indicator for some clues. Now, in a move lower, I'm comparing the lows. So if in this case, I compare the high, because I'm looking for a break higher, in this case, I'm comparing the lows. So in a downtrend, we compare the lows. In an uptrend, we compare the highs. So if I take a look at this movement, and really, as you can see, this is kind of like a meh lower low. So if I take those vertical lines, I did make lower lows on price action, but the momentum indicators made a very obvious lower low. And if I'll take this candle right here, you can see that this is going to make another lower low. So the question becomes, even if we're sitting just around here, you can see the sharp move down. So, and because we don't have yet this information, so from here onward, it's gone. So the question that we need to ask ourselves is, if and when the market will break through that area, will break through that low, will the momentum indicators follow suit? In this case, we can see the answer is yes. So that gives me once again a stronger kind of like probabilities that if I decide to sell this market are probably in the direction of the overall momentum. Remember the beginning of the session, we talked about that 33%. So now I'm increasing my favors toward a higher probability, which really is all that we're looking to do with a trade setup. We're looking to increase the probability that our opportunity is going to go to target rather than the other way into our stop loss. So this is another way that we can utilize the momentum indicators. When we have a momentum breakout strategy, so I'm just going to draw, let's say we come in here from an uptrend and we have a compressions of price under a level. So a lot of the time, the question is, how do I know that when the market go ahead and take this level, right? Is it going to continue higher versus reverse and have a fail break? I mean, one of the things that new traders are banging their hand against is, how do I know that this is not a fail break? How do I know that this is going to continue? One of the things is, first of all, look for a trend. Do I have a trend beforehand? So yes, I had an uptrend. So the overall momentum is to the upside. So that tick about that. I will look at higher time frame. So this is something that we'll discuss next week, but we will look at higher time frame to see that the higher time frame are also supporting the direction. So let's say they do. So another tick, but hang on. Does that really mean the fact that we are sitting here in a nice uptrend? Does that mean that we're going to break and continue, let's say, to my target that sits here, rather than have a tiny little break and then reverse, have a deeper pullback, and then start another uptrend over here? So that will be in line with the higher time frame. But for me, for my opportunity, when my stop loss sits here, I'm going to get stopped out. So I won't be happy about that. So how do I know? How can I look at my setup and say, hey, this setup actually have a high probability opportunity or a high probability likelihood that if the level is broken, so if this resistance line is broken, it's going to continue higher, and maybe even, let's say I picked up my target correctly, will even get to my target. Yeah. So what can we do? Well, we'll look at the momentum indicators, and what we're looking to do is pretty similar to what we've done here. So we would look at the momentum indicators, and as the market is coming into those highs, then we will look at what the momentum indicators are doing. Now, if I have momentum indicators that look something like that, and the question that I need to ask myself is, and this is basically it, if and when the market will break through that level, will the indicators follow suit? Now, if the answer is yes, because I can see it where it sits like that, the higher likelihood is yes, they would follow. Then I can say, okay, I've got a better probabilities here. I increase my odds because the momentum is behind me. I've got that power of the momentum supporting me. On the other hand, as the market is making higher high, the momentum indicators, they're doing something like this, and then they start doing this. So you look at it and you go, if and when the market will break through that level, what's the likelihood that the momentum indicators are going to follow suit? Now, what they're doing here is actually pointing to a lower momentum. Excuse me, that the momentum is actually running out. So in this case, if I've got momentum indicators looking like this, then I could say, actually, that could be the making of a failed break. Okay, so when we're looking at momentum break, so we've got a flat level and we're looking for that trading strategy, one of the things that we can add to that strategy to increase our probabilities is that question: if and when the market will break through that level, will the momentum indicators follow suit? Okay, and the way we also do it, we don't only look at one momentum indicator. You think about it, like I mentioned, the RSI is a little bit more sensitive. Yeah, so if the RSI is a bit more sensitive, then we probably wouldn't want to just trust the RSI. What about the MACD? The MACD can be a little bit too slow. So can we trust only the MACD? Well, what about if we take them all? And if I say, for example, two of them are converging and the third one is flat, then I'm actually quite okay with that. But if I see two of them diverging and one of them is flat, then I go, that's probably a failed break. So we can utilize the three really to make an assessment. Do we have a high probability opportunity or not? Do we have a high likelihood of a break and a continuation rather than a break and a fail? Any questions about that before we move to the next one? Yeah, okay. So let's continue. All right, so the next thing is we want to talk about this idea of convergence and divergence a little bit more. So what we want to do is also, we talked about it a little bit in a context of the momentum breakout, but we were also going to discuss this in a context of the of a trend, because we're not just want to use them if I have a momentum breakout. I want to use them to say, let's say I've got an uptrend. Let's just draw that in. So I've got this uptrend, and I want to know if I'm looking for a pullback. Remember that pullback into the averages and a continuation. I want to know at this pullback, there is indeed a higher likelihood for a continuation and another higher high, rather than trigger me in, reverse, and go lower. Right? So I want to know that in a trend as well. I want to know that when I'm looking to trade those swing lows in an uptrend or swing highs in a downtrend. So basically trade pullbacks. Because think about it, we don't want to trade this part. We don't want to sell here, right? Remember the idea of extension. If I'm selling here, I already moved quite a lot. I've got all this move already. And my stop loss in the most protected place would be above here. So look at the huge distance that I need to move just to make another one-to-one. That's going to be somewhere here. The market already moved quite a lot. So what's the likelihood that the market will keep on going, touch a target, and then starts to pull back? Very, very low. So that's why we want to grab the market when it's already released the selling pressure or the buying pressure. We want to look at those turning points. We want to look at the swing highs or the swing lows. So when we do that and we're in the midst of a pullback, so the sellers, or in this case buyers, in control, then I want to know that I'm actually in the right direction. If I get a signal here, I want to know that it's the right time to sell this market and this thing is not going to keep on going, for example. So the other thing that we can add is consider fundamental indicators, but I want to spend a couple of moments around this idea. So this thing about interest rate often impacts stock market valuation. This idea of interest rate, this idea of good news are good news and bad news are bad news. I think if there's anything that we've learned from the last couple of years is that nobody knows. So even now, we've seen this. It was such a certainty back at the end of last year, so back at December, that the Fed is going to cut rate in March, and they're going to be 6 rate cuts in 2024. And all we have to do is get to April, and we heard Powell say yesterday that actually we're not even sure about 2. So the economy is not something that I've seen anybody actually capable of predicting and predicting correctly. There's been those who keep on, charting along on the fact that there's going to be a recession. And at some point, they probably are going to be correct, but the timing is the hard part. And there was a lot of talk that the stock market back in November, before the rise, so before October, it's the sell-off is because of the high interest rate. But the high interest rate haven't changed, and we still have a very strong market up until pretty much the previous week, the last CPI reading that came from the US. So the thing about thinking about fundamental indicators and think that, hey, if the interest rates are rising, therefore this needs to happen. I think what happened in the last couple of years basically blew it out of the water. Anything and everything can happen. We've seen situations when good news are perceived as good news and the market is going higher. And then we've seen situations where good news are perceived as bad news and the market is being sold off. So it's a bit harder to look into those fundamental indicators and decide based on them what the market is going to do overall, what the share market is going to do. So be very careful around that. It's the same thing as with interest rate and countries. So for example, there's still big expectation for the Bank of Japan to do something. So that 152, I think we spoke about it last week, was the area that the Bank of Japan said we are definitely going to intervene, and all those very, very strong wording. And then turns up it's not so easy. And turns up we're now sitting, I believe, at 154. So it's not so easy to do all of that. It's not so easy when the dollar is so strong against so many other currency to go and prop the your currency, especially when the bank is not really interested in increasing their interest rate altogether. So it's very, very hard to make a decision based on fundamental indicators because they're not always the same end result. So just keep that in mind. It is really important to look at the economic calendar. Really, really important. The reason for it, it tends to move the market. So just have a look at what happened when CPI for US came out. That was a massive move in the market. It's kind of like the market awakened to the fact that maybe they're overvalued the stock market and the rally was too strong. But up until even in February, it wasn't enough. Even February reading wasn't enough to convince the market. So all through and through, it really depends about we've got this lots of woods and they're all soaked in turpentine and we're just waiting for the one match to come, but it doesn't necessarily mean that we know which match it is. So be very, very careful from making decision solely based on fundamental analysis, thinking that we know what it means. It doesn't mean that you might be wrong, but it's just that idea to think that we have the power of prediction. And it's actually been proven that nobody does, not even the biggest one. Nobody knows. And I think if we live when we look at the market and we go, actually, I don't know what the fundamental analysis might do, but what I do know is, say, 10:30 our time, big economic news usually out of the US are these clocks syncing between the US in daylight saving and us in regular times, then we know that around that time, they're going to be big economic news. They're going to be big candles. They're going to be even wider spread sometimes, and that can affect our opportunities. So that is why we have to pay attention to the economic news. It doesn't mean that we have to guess what they're going to do for the market, but we have to be aware of them. So that's just a sideway note about fundamental analysis. We all love to read about it, but take it with a big, huge grain of salt because nobody really knows. The thing about technical analysis is that we're looking for a reaction to levels, and there's a difference between something that is fresh versus something that was there and been tested a while ago. So that's another element to it. So let's have a look at this idea of convergence and divergence that can help us within a trend. So in this case, we only have the RSI. It's not a fantastic example, and I'll show you why. Because in this case, when they spoke about convergence idea, they're looking at these two extreme highs, right? So they're saying from this high to this high, we have convergence. But we cannot ignore the fact that there's another high here. And that's somewhat of an equal high, or a little bit of a higher high by the look of it. And the RSI, what it did, gave us a lower high here as well. So if we were thinking about an opportunity here, we might decide against it because the RSI is telling us there's divergence. But remember, the RSI is quite sensitive as well. So that's why we want to look at different indicators altogether. So what I want to do now, just as we talk about this idea of convergence, divergence, because I don't love this example, I want to bring the live market so we can have a look at other examples. So let's take a look here. So hopefully you can all see this. I need to just delete my previous drawing. Okay, so let's have a look at what's going on here. Just a little bit of big picture kind of moves. So if we take a look at what happened here, and as you can see, the RSI is very sensitive in this case. So I might just put it on a weekly, so we'll see the movement a little bit clearer. So this is Swiss yen. So let's have a look what's going on. Can you see this high? And then we went to higher high, right? But if we take that vertical line, then we can see that what the market is doing, oh, that is not a straight line, but forgive me for that. You can see that though. You can see that both of the indicators are actually diving, right? So the market has been making higher high, but the momentum indicators are making lower highs. So what it tells us is that probably the momentum is running out. Now, it doesn't necessarily mean we're going to get a massive pullback, a strong pullback. Because if you take a look at this area, from this high to this high, this is a proper pull here. But you can see that the momentum indicators are actually converging here. So it doesn't necessarily indicate that we're going to have a pullback, but it's indicate that we're running out of momentum. And if we were thinking about a lower time frame entry, if we were thinking about, oh, let's take a break of this level, we might be thinking again. So what the momentum indicators and their divergence over here is actually kind of like a warning sign. They're basically saying to us, if you're thinking of a buy opportunity, maybe you should think again. Maybe it's not such a high probability. Now, one point about that doesn't mean that the market can't go higher, right? That doesn't mean that it won't happen, yeah? So when we had that divergence, we really had this divergence before. And eventually, because you can see from this high to this high, we did pull back and went to a higher high. So when we look at one leg divergence, it's not as strong indicator as we have three leg divergence. So three leg divergence is basically if I had here another higher high and that one would diverge as well, then it's a stronger signal, okay? What we can also see from a convergence point of view, so basically convergence means if the market is making higher high, are the indicators follow suit? And even though we had a good pullback here, that's some selling going on, we pull back into the averages, yeah? So when we pull back into the averages and we've got convergence on the momentum indicators, then we are more happy to look for a potential buy signal, so a buy setup. Because what it's basically saying to me is that if you see signs that the pullback is over, such as a bullish candle sitting here in the buy zone, which is again the area between the 10 and the 20 moving averages. So if I get a setup here and I'm looking at the momentum indicators and they say to me, actually, you've got very nice convergence, but the market makes higher high, momentum indicators makes higher high. So if you got signals, you know what? You've got the momentum of the market in your direction. If you get the setup, if you don't have the setup, there's not much to do. And indeed, we got a bullish candle here sitting in the buy zone, a break above it, and we've got a continuation of the move. So what we're looking for is confirmation that the direction that we've chosen is correct, or so in this case it's that idea that I have convergence on the trend so I can trade the pullback, or keeping me out of a trade that might not have high probability to succeed, such as in this case. Okay, it doesn't necessarily mean that we're going to start seeing a sell-off, but it means that we're running out of buying momentum. Okay, so this is a quite nice example for this idea, and we can start looking at other elements. So we can see it here, for example, we still have convergence through and through. And yes, in this case, we didn't have a pullback and a bullish candle in the buy zone. But if I drill down into the daily chart as an example, and maybe the daily chart gave me a setup to enter, then I know that I've got the backing of the momentum and the trend of the higher time frame. So that slowly increases my probability. So I build up my odds. I'm moving from that 33% that we started with to maybe 40, 45, 50, 60, 70, 75, which every technical ingredients that I'm adding and increasing my probability. Any questions about that? All right, so let's move back into our presentation. So the next thing that or the last thing that I want to talk about is pivot point and Fibonacci. Now, the reason why I'm talking about these ones are more leading indicators, because if you think about the question, when we talked about the momentum indicator, it was if and when the market will break through that level. That's kind of like a leading note. Having the markets or the momentum indicator diverging on the highs, as an example, that's a leading indicator that a pullback might be on the card. Doesn't mean that it's happening right now, right? If you think about a crossover on the MACD, then it's already happened. So that's a bit more of a lagging indicator. So this is going to be a bit more about the leading indicators idea. So the next thing that I want to talk about as a leading indicators is the pivot point. Now, the pivot points are back from the days of trading the pit in Chicago. And the idea behind them is that we're taking the high of yesterday, the low of yesterday, and the close, and we're creating pivot points out of it. It basically lines are forward lines on the chart. So it's line of areas that haven't happened or haven't been traded yet. We also have, we can do that for the last daily candle, we can do that for the weekly candle, and we can do that for the monthly candle. So which means we have daily pivot, weekly pivot, and monthly pivot. With the pivot themselves, we've got the mid area, so that is the pivot. And then we've got S1, S2, S3, which are the support areas, so that's below, lines below the pivot. And the R1, R2, R3, which is called the resistance, which are the lines above the pivot. Now, it doesn't mean that if there is a pivot, the market ought to respect that line. It just mean, and if you think about it, at the end of the day, even the bots that looking at the market, they've been programmed by humans. So there is some sort of expectation for something to happen. So if we're all expecting something to happen, if we're all expecting a line to be respected, then we might see some reaction to that. There might be those who will put an order to enter at that area. There might be those who are already in a trade that put an order to exit at that area. Either way, we might see a reaction. So what we've got here is historical pivots, right? So historical pivot is in here just to show you how it looks like previously. But you do want to look at them forward. So when you add your pivot, you'll see lines at the area that the price hasn't been yet, okay? And that would cover the entirety of the day. And then when you look, let's say on the 4 hours and the daily, you can also have the weekly pivot that looks at the entirety of the week. So on a Monday, you would have the first, you will change to a weekly pivot, and on a change of a month, you will change to the new monthly pivot. Now, you can see in this case, it's not always respected. So if we'll take a look kind of like in hindsight, you see that this one wasn't really respected. It stopped a bit. This one stopped a bit higher, so it wasn't really respected. This one, by the way, this pivot wasn't there yet. So this one didn't respect any pivot. But if you look at where this one kind of like consolidated, it actually consolidated on a pivot line. And then it went higher. It didn't really respect this line whatsoever. So it doesn't mean that we always have to respect it. Question: how much weight do you give to an indicator when you are entering a position? Great question. Personally, in my own trading, not humongously a lot. That's to be the honest truth, because I believe in price action, and I think that price action is the one that gives me the biggest picture. I look at the indicators like a cherry on the cake. It's not the cake itself, it's not even the topping, it's just a little bit of an added value. If an indicators are screaming at me something, there's a big divergence, usually I tend to see it from the price action itself. You tend to see this running out of momentum. When market is pushing higher and higher and higher, it doesn't necessarily, unless it's a big economic news, it doesn't react with a ting and a fall. There's usually, before it kind of like rolls over, it shows you that it's about to roll over. The indicators will support that, which helps. I think for a beginner, it's a really nice way of comparing what you're seeing with the price action to what you're seeing with your momentum indicators. Actually, if you want to see, because I've got a YouTube channel that I put my trades on. So what I do, it's not really, it's kind of like a swing trading ideas, and I've put what I do. So it's more for education. It's more for technical analysis, just so people, a lot of clients that I have can have a look at what it is that I'm looking at, and then go ahead and make their own decisions. So it's called the Knockout Trader. If you're interested to see, you'll see a bit more of how I'm utilizing the price action analysis. So it's more about the price rather than the indicators. But ignoring them is not a smart thing either. So I still have them, I still look at them, but they won't be the make or break of everything, but they will be there for warning signs. So like I mentioned, I wouldn't look at a MACD and say, hey, there's a crossover, therefore I'm there. Because I showed you a couple of issues with that. And I don't like it when I get a signal, but the signal has issues, right? So I prefer to have a setup that is in its core a high probability. So if the price action in itself is high probability, then the indicator usually tend to follow suit. But for example, if I see, there's two things that I would say to you again. There's another thing that I look at, which is location and intention. So the intention to me is the setup. The location is where it is in the chart. So if, for example, I've got a beautiful setup, so I've got the intention, but the market is very, very overextended, then I won't take it because the location is wrong. So overextension, I can see, you can see this from the price action because you can see you've got a very, very strong move. But this is a kind of like an indicator idea because I've got the moving averages and I can see the distance to the current price action. So when you have massive overextension, to me, it doesn't matter how great the setup is, I probably will give that a miss because more likely than not, I'm going to get caught up in a pullback. So I'd rather be patient, wait for the pullback, and then look for that setup. So that answer your question? Which is a long answer, I agree. But it is really, really a good question around that, because when we start, we get confused. Which one is correct? What do I need to use? And you'll see a lot of new traders, they're using a lot of indicators, and they end up with paralysis by analysis because at the end of the day, all the indicators are telling them different things. So if you strip down the indicators and you look at the price action, that is the king or the queen, depends. It's just that is the thing that will tell you the most about price action is price action itself. Everything else is a derivative of price action. Okay? Let me know if you've got any more questions around that. Okay, so the next thing that we want to talk about is Fibonacci retracement, and by that, it's called the knockout trader. So kind of like a knockout, like a KO, you know, like fighting, because that's what I do as well. So that's why it's called the knockout trader, because I'm looking for knockouts to knock out the market. I look at trading kind of like a fight in the ring, because it is. If you think about the psychology of trading, it's pretty much very similar to standing there in front of an opponent. You don't know what they've got. You don't know what they're packing. And there is a little bit of that happening in the markets as well. So that's why I name it like that. It's mostly for fun. Yeah. All right. So let's talk about Fibonacci retracement. So Fibonacci retracement, the common ones are 23, 38, 50, which is the midpoint. It's not really a Fibonacci retracement, 61.8 and 78.6. Now, the 23.6 and the 38.2, these are the shallow. This one, and I would add here the 8, are a pullback. These two, we go, this is the sweet spot. So if I've got a trend, and we tend to draw a trend because you're looking for that reaction to the highs and the lows. So I'll take the Fibonacci from the low to the high. And if I'll see, for example, the previous swing high is clustering very nicely with the Fibonacci sweet spot area, and I get a pullback into this area and I get a signal here, then I've got a lot of elements that says to me there's a high probability for a continuation. So I do like to use that just to see where we are in the pullback. When you look at the pullback of this one, the shallow pullback, we tend to see them at the beginning of a trend, and then if we might end up with a setup somewhere around here, and then the market decides to pull back a little bit more. When we're looking at this one, these are deeper pullbacks. So if we're in an uptrend, coming back almost 100%. So that tells you whoever sits here, there's quite a lot of sellers here, right? So this is why we're looking at this as the sweet spot. Now, in the example that we've got here, we've done, they actually took from the ultimate low to the ultimate high. And in this case, it's sort of matched, but it matched because there's a level here as well. So it's kind of like hard to know. You can see that this one, it didn't really match. The pullback here matched because it pulled back into the breakout level. So there's a few more elements around it. What we do want to see, we want to see the market, we want to see those ebbs and flows, right? So if we'll take a look at this move, because let's do it in a clear area. So what I'll do, I'll say, because this is on the way down, so it's not that fantastic, but let's take a look from this low to this high. You can see that about 50% retracement is coming up to this area. We don't see anything else to the left, but you can see it touched that area and skedaddled out of there. So it basically reacted to that sweet spot. So we can utilize the Fibonacci retracement in a way of a leading indicator to tell us where the market might finish its pullback. So we're looking at a trend, and it's the same in the downtrend. We're looking at a trend. We will draw from the high to the extreme low, and we will look at the pullback. And if the pullback is coming back to that sweet spot area, looking for a setup here could be a higher probability opportunity. Sometimes we might even look for clustering of reasons. So if I have the 61.8% retracement, the previous swing high, and who knows, maybe this is some sort of a level, a very strong level of support and resistance, that the market now broke through and pulling back to test it from below. My God, I've got a couple of clustering elements here. And I could decide, hey, this is looking so great. It's in a downtrend, there's a level, I've got the Fibonacci retracement and everything. I might even decide that this is a limit order. Basically, wait for the market to pull back into this area, trigger me in, and look for a continuation of the move. That is utilizing the Fibonacci retracement in a leading way. The other way to do it is to use the Fibonacci extension. So to go, okay, so this is the move, and I'm thinking, and I've already got in, where would be my target? So I can look for the Fibonacci extension for that. But I would say this, it is better, in my view, to look to the left, to look to the chart itself, to look for areas that the market might finish that push and might find, in this case, some demand level and decide to start to pull back. But again, if we have some sort of clustering element, that can help us as well. Any question about the Fibonacci retracement or extension in this case? They're all the idea of leading indicators. All right, so next week, we're going to add the multiple time frame analysis and also look at how can we place our first trade. We are going to be using, and this is what I've been using here as well, a risk-free demo account. So if you're just starting, if you're new, if you're not sure what you're doing, do all your playing on a demo account, because this is the place for us to learn how to execute those trades, how to calculate our position size, how to look at potential stops, target, what does it mean, how many contracts, and all that. So we're actually going to do an example of that idea utilizing the demo account. So if you've got any questions, I'm very happy to stay and answer them. If you've got any question about the platform, the accounts, or anything else, the great team at Vantage will be very happy to hear from you. You've got their contacts on the screen. You can also contact them on social media as well and follow them on the various social media platforms. Thank you so much for everybody who joined me here tonight. I wish you happy trading, and I look forward to see you next time.